Professor Rex here. I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged, and it prevents them from falling asleep in class. To show them accounting concepts in action, starting 2 years ago, each Monday I invest actual real-world money, the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. In 2022, the market did not perform very well, but in 2023, stocks took off. Currently, the portfolio's value is over $1,600. The portfolio's return has been 17.64% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on my next slide. So why do I invest only in dividend-paying stocks in this model stock portfolio? The first reason is, according to a Hartford study over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.18% per year, but for non-dividend-paying stocks, average return has been negative. The study seems to be updated each year, so go check out the source link that I include at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you're to panic and sell at the absolute worst time. So why are dividend-paying stocks less volatile? Because most dividend-paying stocks are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently and are positioned to increase their dividends in the future. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? My next slide explains that. The main reason why I invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you do not need much money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, in other words, fractional shares, I can quickly and easily create a diversified stock portfolio with little money. And this is the thing that a lot of new investors don't understand. They think you have to buy a whole share. No, not if you have a brokerage account like Fidelity. You can buy as little as $1. So you could buy $1 of Amazon stock or NVIDIA. So originally I invested $25 per paycheck into this classroom portfolio, but found the process to be so fun because I'm an investment geek that I split it up and I now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation, which is about 3%, to replicate the fact that people's paychecks usually increase at least by the amount of inflation. So in other words, as people go throughout their career, they make more money, therefore they can invest more money. And by the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research I discuss in class is the same research I use for myself. And another reason I started with a low investment amount was because my students are often wondering, well, how much do I have to invest per week to have $1 million at retirement? Well, it turns out it's only $11.74 per week, assuming you get the average historical return of stocks, which is 10% a year. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions of their investments would increase by 3% each year, which is around the historical rate of inflation. So in other words, if you invest $11.74 for a week in your first year, the next year would be, so on my calculator, you can't see me doing this, times 1.03 would be $12.09 per week of the next year, etc. So what are the 10 dividend growth stocks that we bought this week? Well, here they are, ranked from EOG Resources, an energy company at number 1, down to number 10, PepsiCo, which I'm sure everyone is familiar with. So I also show their industry, how undervalued they are according to our research, their risk rating as compared to other stocks, quality grade, which we'll discuss in the next slide, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends. And our methodology used here indicates that they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. So once again, we're not emphasizing the highest yielding stocks. A lot of times those are value traps. In other words, they're dangerous. So on this slide, I want to show the components to my quality grade. So we got risk/uncertainty, competitive advantages, management, and financial health. Quality-wise, we only invest in stocks rated B- or better for this portfolio. So risk is the first quality component, as you can see that the stocks with the lowest risk as compared to other stocks are McDonald's and Pepsi, followed by Martin Marietta, Apple, and NextEra Energy. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. This week's purchases with the best competitive advantages are Visa, Apple, McDonald's, Starbucks, and Pepsi. The next quality component attempts to evaluate the company's management. My evaluation includes both management's use of capital and general decision making, but also my research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And for those of you who are not accounting majors, earnings is just a fancy word for profits. So you want to make sure that the balance sheet and income statement are showing realistic data and not something that might be a little bit fictional, which companies like Enron like to do. The best management ratings for the companies we invested in are Humana, Martin Marietta, Apple, Starbucks, and Pepsi. And finally, the last quality component is financial health. The best of the companies we bought this week are Visa and Apple, followed by Martin Marietta. Now notice Apple showed up on a lot of those best of categories. But unfortunately, Apple does not have a high yield. It's only 0.5%. So everything comes with good things and bad things. It's all about a balance. So remember, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and higher yield are EOG Resources, NextEra Energy, Morgan Stanley, and Pepsi. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it works. Companies that are already paying out higher dividends, such as PepsiCo, rarely have the greatest potential for the greatest growth in those dividends. In our list, you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are those with some of the lower dividend yields, like Humana, Martin Marietta, and Apple. Now, the company with the best combination of recent dividend increases and future dividend increase potential is EOG Resources. And that's one of the reasons why they rank number one in our list of 10 stocks. So those are the companies we bought this week. I'm trying other strategies too using real stock portfolios. Besides this dividend growth strategy, I'm also running the following portfolios: high yield dividend paying stocks, stocks with the best competitive advantages. Now, a lot of people in the investing world call competitive advantages moats. Warren Buffett is famous for coining that term. And in this particular portfolio, I invest in both dividend paying stocks and non-dividend paying stocks like Amazon. I also started a technology-focused portfolio investing in these themes: artificial intelligence, big data, cloud computing, cybersecurity, and software as a service. And finally, just for fun, I started a dividend growth strategy portfolio that invests in every sector, matching the S&P 500 sector weightings. This one is the biggest challenge because some sectors are more likely to pay dividends than others. So if you have any questions in the comments of the video, let me know. And also, if you'd like to see any other type of investing videos, let me know. Or if you'd like to see more updates about this particular portfolio, let me know. Remember, I'm making 10 stock investments each week, so it changes from week to week. And finally, here are other places you can reach me besides YouTube. You can reach me at Twitter, also known as X now, LinkedIn, and my website, beatthestockmarket.com. Have a great week.